Hi, I want to welcome everyone to today's webinar, Passive Investing Through Syndications with Josh McCallen of Accountable Equity. Just a quick disclosure, Capitalization does not endorse, give tax, legal, or investment advice. Everything presented here today is for educational purposes. We encourage you to work with your investment advisors, CPAs, attorneys, accountants, etc. This is my contact information for anyone who's interested or needs more information about using a self-directed IRA to get involved in what Josh is going to go over with Syndications 101 here. I can be contacted at rfisher@camaplan.com, or you can reach us at the office, 866-559-4430. I'll let Josh kind of take it over from here, but for the new people that are joining us, Josh, why don't you give us a little brief intro about you?
Yes, it's an honor to do that, buddy. And you can hear me through this mic, right?
Yes, sir.
Making sure we have all the best stuff here. My quick bio is I'm a father of 10, which is my biggest claim to fame, married 25, almost 25 years. But I'm today in the business world, we are known as a resort turnaround company and a syndication group of investors. So you combine those two things and we end up really touching many, many people, hundreds and hundreds of investors worldwide, about 1,500 people in our investor community, Accountable Equity, and some of the most fun resorts you can imagine visiting. And please do. That's what we are today.
Awesome. Great, Josh. I think you're able to take over. I stopped my share.
Oh, okay. And you know what we've done here, guys? You're gonna let me see here. I have this. Boom, boom.
That's your beautiful resort right behind you in the background. Looks nice.
It is. By the way, is yours a slide behind you? No, okay. So you got a great looking background right there. I love it.
Nice.
Oh, sorry, guys. That's not what I meant to have start off here. You should always start at the cover page, is what they teach you in the presentation manual. Here we go. Thank you very much. Since we've already done the introduction, I just want to welcome everybody from Capitalization. We have, I would say, double-digit number of investors from the Capitalization community, which means we care tremendously about the work you guys do. And it's an honor to have you here. My daughter just joined. Hold on a second. Honey, I'll be right down. Your sisters will take care of you. Go ahead. That's never happened before. Hold on one second. Sweetie, I'm speaking to people. Can you just go down? Tell them that you can. Never had that happen before. With
That's
all
right.
the
She's making you look good.
No, she's not. All right. Well, you know what it was is today, my lovely wife, as you're looking at this screen, feel free to pull out your iPhone because all of those QR codes work. But I will tell you the quick story is my lovely wife, Melanie, who's in the cartoon character next to me on the Wealth Building with Friends, is she and I work full time at the property. We also, of course, have children. So today she needed to be on site with all the design installations. We have a winter fest going on. So anyway, so I'm watching the two of them. Anyway, so what we're about to present today is not meant to be an academic lecture. It's about a 30-minute presentation or however you want it to go. And, you know, there's a Q&A section at the top. And what we're going to share with you, and these resources I'm putting in front of you, are the ways we've developed our concept and understanding of private investing through syndication. And we're going to share all that as much knowledge we've gained and experience we've gained. It's yours today. But the best way for you to have it and get it is Q&As. So as we're going through this, unlike other types of presentations, we will just stop and answer your question. I almost wish it could be like a live dialogue, but it can't so much with this software today. But we will make it as live as possible. So that the slides are really there for conversation starters and are not meant to be an academic deep dive. But over the course of dozens of Wealth Building with Friends where we actually profile investors, that's one of the best ways to understand how syndication works, is shows like that. And these shows obviously come from our heart. But shows like that, where you actually hear investors talk about why they invest in private syndications, it'll unlock the last few hurdles that you may not yet even realize you have some hurdles if you're not currently investing this way. And then, of course, Capital Hacking is our show because most of our listeners and investors are people that have really successful careers and jobs, maybe small businesses, and they need to understand how this private investing world works. So we teach that. A really great resources, not from me, but that gentleman, Brian Burke over there. I highly encourage you to check out that book. That's The Hands-Off Investor by Brian Burke. And it is an academic work, meaning you use that before you would invest in a syndication, would be my advice. Not necessarily this presentation, is more to get vocabulary down, answer a few questions. But Brian Burke really explains his process, his methodology of advice to people like you and I when we go to find investments. That's him explaining it in short form on our podcast. So click that QR code and you'll hear him explain it to our community. And of course, that's our community. Now, again, as a conversation starter, feel free to start putting Q&As up there. I'm waiting for you. We have a dozen people up there. You're allowed to put Q&As up right now, but I want to share this story. That gentleman right there, leaning up against the bomber, probably in the 1975. That's probably 1975. That gentleman was Marty Boback, and regrettably, we lost him last year. But when we made this slide the first time, he was still healthy and alive. He died tragically. That is Melanie's father. And over the last 4 years, as we transitioned from being a very strong operator of resorts and a developer into becoming a syndication professional that allows people to join our projects, there was this major mental shift that happened that I want you guys to hear. And he said it better than anybody. The guy worked his butt off till the day he died, provided great for his family, my wife's family, I mean, and never owned anything. I remember seeing at Thanksgiving 5 years ago, 4 years ago, when we were learning how to build syndicated investments for people like yourself and myself. And he just couldn't, he was like taking a deep breath and he goes, I've worked my entire life. And, he made a good salary at the end of his life. He goes, I own nothing that produces cash, no assets other than his own home. But even that, he had a very large mortgage. So I say that to you because what we're here to talk about today is so transformative if you let it be. And that is private investing in things like what we do and what wonderful people do. I have a bunch of other people out there that do it. I could tell you all about them. You can ask me and put it in Q&A. You're owning something. It's more than just owning a stock certificate. It is owning usually a business or a piece of real estate that's throwing off cash. And it truly comes with all the benefits too. It depends how you invest. You can invest through your IRA, of course. And other times there might be strategies where you don't use your IRA. There's both powerful. So I just encourage you to check that out. I was really pleased, Ryan, when your team said that you wanted to position this presentation this way, like own a piece of history, be a part of something great, all the while creating great tax strategy for your finances and providing great returns for your family. This was actually written by Camaplan, and I just had to give you guys compliments because I'm like, I love that. Ryan, did you write that or did your team write that?
A little combination of both.
I like it because it kind of corresponds to Mr. Marty Boback, You and I know because you've been to our properties many times. They're historic and they're cool and you own them. And a lot of Camaplan owners, through the proxy of their Camaplan relationship, their self-directed IRA, they have the benefit of ownership through that mechanism. And it is doubly rewarding. It's producing yields. That's always great. But it is I think it touches the heart. So I thought that was very nice of you to write it that way. And then these were the 3 topics that Camaplan thought were the questions of the community, meaning, how do you find deals like that? How do I know these opportunities are sound? And what is the process for an investment such as that? So we're going to use that framework to have a conversation. And I do encourage anybody that's looking, even if you have a Q&A question where you want to talk about a deal structure, ask us. It'll be advantageous to the community. First thing I always say is before we talk about how do you find these deals, just know how your personal philosophy for investing is built. What I love about and what you love about IRA investing and self-directed IRA investing, you have a larger horizon, especially somebody in their 30s and 40s, you have a horizon. So you can invest in these wealth building type of private deals and wait for them to get cash flow. And then all of a sudden they make a lot of cash flow and you have a good wealth. But that's not always the case. Take a look at one of the projects recently this is just an example. This was a really successful stabilized project where people were offered, do you want money monthly? You see in the blue with the little dollar symbols, or do you want to compound your money? A lot of Camel Plan people say compound my 10%. And they do that because they're not actually looking for stable cash flow because it's sitting there growing. However, there's others that want to see the steady payments and watch how how companies like us pay the distributions. And of course, we're consistent and we've been in positive repayment since we first launched. So we've always made all our payments. So you just kind of choose. Do I want to see money coming in every month, or would I rather postpone that gratification for what other benefits will you offer me? Will you offer me compounding?
And
And with
that does depend on the person there, Josh. But like you said, a lot of people, especially with IRAs, some do want to see payments or use payments, every month. But a lot of other people aren't even at an old enough age to take money out, so they'd rather grow it more rapidly and keep that money working and reinvested.
Yeah, and that I appreciate you saying that, Ryan. And by the way, that's and anytime you want to add, I'd love it. You're absolutely right. I mean, the Gamma Plan model is that your money it's in the IRA mechanism for the code, right? So if it were to generate strong yields that aren't offset by depreciation, it doesn't matter because it's inside that box, and you already know your tax consequences are not happening now; they're happening later. And as a matter of fact, the Carl Fisher is the best at explaining what does it go from forever tax to never tax. I think the new tax code still allows most of what he taught, which is awesome. The Roth IRA. The
Yeah,
next thing,
and it looks like they took they had the IRA stuff in there and they were going to change that up, which you're probably well aware of if you want to touch on that. But from what I saw last, it's been taken out.
yep, that's my understanding. I was just on a call with a CPA today, and he said they kept the backdoor provision. They want that gone. That's that idea where people with were able to backdoor and put a bunch of money into Roth. Too complicated for this show, but for the most part, for you and I, and for so many, like 99% of us, the Roth is still intact, thank God. Um, and we can use it to invest in private deals. This is one other way to think about your personal investment philosophy. Just go through the types of deals that exist out there. And I guess top right would be multifamily, very high end multifamily, by the way. You, if you're on this podcast, or this is not a podcast, this is a webinar. If you're on this webinar, you may know people who do multifamily investing. And as a matter of fact, my staff says I can stop sharing for just a second. Multifamily investing is what most of us have used as the primary. That's like the primary way many of us get involved in syndications is through multifamily. And of course, I know, and you might know many wonderful multifamily operators. So that's top right in my little model I'm about to show you again. Um, and then, of course, I always say, so pros and cons of each. Then I'll just go across the left, though. That left looks a lot like single family rental / Airbnb. Very curious and interesting. A little challenging from an IRA. Bottom left is self storage, a really, really compelling asset that I'm a big fan of as well. And then bottom right is these kinds of high revenue hospitality resorts that we do. Obviously, I put it in there because I'm on the show. Not as common. As a matter of fact, of all the multifamily syndicators I know, each of them, when I'm spending time with them, they always say, "You're Josh. You're the only one I know in hospitality." But the same could have been said just 5 years ago for self storage. There wasn't that many people doing it. Now there actually are. Or how about mobile home parks? We all know the Bigger Pockets gentleman, Brandon Turner, just 4 years ago helped. I mean, of course, everybody, there was always mobile home parks, but about 3 to 4 years ago was the first time the major new push to see people going to syndicate that. Maybe we're leading the charge in hospitality, but each of them have their pros and cons. And I think, again, questions and answers right now would be great. I'd love to see some Q&As. Let's go into it. I mean, here's my pros and cons of each of these if you want me to opine for a second. I would say I'm bullish on actually all four of these categories because I think multifamily is the perennial stable asset. People have to have a place to live. Um, so that I would say it's 90% pro. Yes, I will absolutely talk about that. Discuss. Ali says, can you discuss the return profile for some of these categories? And that I'm going to do my best because I actually have probably looked at deals from other people on all of these. So let's talk about that, Ali. Um, Ali, if you don't mind, I'd love to share a little more about the pros and cons and then hit that. That was awesome question. Anybody else? Ali gets the gold star for being the first chat question. Multifamily biggest pro is it's perennial, it's in favor, it's going up in value right this minute. The cons, there's only two cons that are mitigated by whatever your opinions are. I would say the only cons are it's trading an all-time multiple, meaning it's really trading at a very high value based on the cash it's producing. That's okay in a sense because there's not enough houses and not enough apartments. So you feel like the reason it's so expensive right now is because they haven't built enough. But you have to take that into account that it is trading at a very, very expensive rate. And then the second thing is very curious. I have been talking about this in many conferences I go to, and this is that multifamily for the first time in my life, I would say got that weird blow during the Corona. Corona, we're all sitting at home. The COVID made us stay at home. But there was that weird government intervention that allowed us not to have to pay our rent if we chose not to. Like there was that forbearance and foreclosure um, thing that got delayed. And that was the first time I ever noticed that the government gets involved in housing bills. You know what I mean? Like they have some say over the cost of housing. So that caused me, and I remember talking to a lot of multifamily people, it gave me cause for pause. I said, is there a day a few years from now when inflation keeps growing as it is that you have to charge 30% more for rent? Are you allowed to charge 30% more for rent, or would the government stop us if we tried to keep up with inflation? And I think the jury's still out on that. Last year caused me to think that that may actually be a risk factor now, unlike I've ever thought before. Single family rental is still the hottest thing going on right now, top left. Of course, short term rentals, the hottest of the hottest. I would say I love both. As a matter of fact, we're in the business of both as well. We own other houses that we bought through the portfolios. Um, I think we all know the risk and reward there. The downside, of course, is managing of those is more expensive and less upside margin. Self storage is a home run. They say it does well when the economy's down, and it says it does well when the economy's up. Um, I probably have a lot to learn about self storage, but I'm a big believer in self storage. I always say when we buy mega properties, like we're buying some larger properties that have hundreds of acres, I always say, should the back corner of a resort property facing the highway be a self storage space? Maybe. So I wonder if I'll partner someday with self storage people to sell some land. And then, of course, hospitality, the biggest con about hospitality, and we're always super transparent here, was the volatility we all just experienced through the corona. And of course, the biggest con there is was the shutdown of the corona. But the positive that came out of that was, you know, for us, we actually had some positives, but in general, there is a shakeup going on in general hospitality. There's a big shakeup going on, and that has affected even guys like us that are and families like us that are doing well. We do well not because we pick up traffic off the highway. We pick up long-term contracts from weddings. So that kind of smooths out the risk curve, but we are influenced by the negative news of hospitality. So that is a risk factor, specifically on debt. Debt is more challenging for us right now. Student housing, I personally would have concern about student housing long term. And then ATM machines, debt funds, and operating businesses. So let's talk about risk profiles. Are you looking for, and does an investor need to be accredited? Okay, so MJ asked the next question. Thank God for these questions, Ali and MJ. Ali asked the first question. I'm going to hit it first. He says, "What should you expect to earn, like a return profile?" That's another great question. I would say that goes back to a stabilized verse. Let me see if I have stabilized as my next question. Um, I don't really have it as my next question, so let me see here. My next page, or one of my next few pages, was about stabilized returns versus growth returns. And hold on a second. I think that's the key thing to keep in mind. And I guess something's going crazy. If you are risk profile, all comes down to the first question. We'll talk about each category, but then is the building already finished, done, fully leased, and what is called stabilized? If it is, your returns are probably going to be sub 10%. If it is in need of a turnaround business plan, you're probably going to be seeking 15 to 20%. I mean, at the highest end, I haven't seen anybody really promise 20%, but that might be where you would want if you were an investor. So I think that's one category. I think I answered that pretty well. The next question is, and then as far as going down that whole list of it, you would typically expect the smallest returns in multifamily. Single family, it depends. If you're on the front end of fix and flip and you're willing to take all that kind of direct risk, you probably have the highest return backing one fix and flipper. Just to be fair, that all comes down to that other investor, that person, and you maybe become his bank or her bank. That can yield very high return. May not be scalable, but it can yield a very high return. Self-storage is probably 12 to 15%. And then hospitality is probably 15% plus. So value add versus stabilized assets. Yes. MJ, what kind of investments are you looking for, and does an investor need to be accredited? You know what? That's going to come up in this, probably the next slide. How do you find deals? MJ's on these things. This is probably the best way to start. Okay. Ali, MJ, everybody. You go to events like this, even though it's a digital event, you now are part of my family and our community. I probably know 10 other, 15 other, 20 other people that do what I do in each, at least a few in each of those asset classes. So personally, I can be your resource. I'm not authorized to be your advisor. I'm not your advisor. But if you want to know, who do I know in multifamily, I can give you one right now. I'll show you right here on the page. If you want to know, who do I know in self-storage, I could find one, mobile home parks. But the way I've learned how to find people like myself and people who provide deals are these websites. You look at the DeRosa Group's a group like myself. You have Bigger Pockets is just a forum. Clearly, Camaplan is always praised on Bigger Pockets for being an incredible company. Go there, you find great companies like Camaplan. If you know them, you'll understand the culture. Real Estate Guys Radio I'm on that show a lot, and boy, that helps you find and meet a lot of sponsors. So it's like a mix of podcasts, and I don't really know so much about Fundrising CrowdStreet. I think I just put them on there as part of the that is a way. It's just not my way.
I'd also just like to mention there, I think you went over it, but I mean, our events, webinars, but like your Learn and Grow, you get to meet people there that have multiple projects because they're investors, and you guys all share that kind of stuff. So, I pay attention to the smaller groups and those Learn and Grow. You can tell them what your Learn and Grow is.
Yeah. I'll tell them. And at the end of the day, don't rush it. Right, Ryan? I mean, sometimes it's a matter of getting to know the people. And that's why in-person events that are coming back now are really fantastic. Camaplan events like this. There's the Strategic Investor Alliance in Philadelphia. Sometimes that comes back. Now, even if you're not accredited, many events are open to the public. Accredited versus non-accredited. Don't let that dissuade you right now. Okay. If you're not accredited, you probably have different opportunities than you're not going to probably have syndications available to you. Not that often, but you can fund a fix and flipper. You could, participate in smaller deals like that. But this is us, right? So this is how you do it. And then of course he's talking about, now we're up to slides like, how do you get rid of some of the risk? Now, in that book that you might have seen earlier, the book by Brian Burke, who I only know from having him on my show, but he's phenomenal. I've read his book. I think he's phenomenal. That's the book called The Hands-Off Investor. It's the #1 required reading if you're looking to become a better private investor, and like you are today by being on the show. His advice starts the whole book. He says, get to know the team. He says the team is where the money goes. Once you write your check into a fund, it hits a fund. It hits an LLC legally set up by a lawyer and CPAs. It goes into this bank account, right? I mean, and then the bank account is administered and a business plan is run and executed by people. So he always says, spreadsheets. He always says, be careful not to compare two deals and say, oh, the IRR on this versus the IRR on that. He says all of that actually can be off by several percentage points, meaning over here, Ryan calculates his IRR by 1 year increments at a time. And Josh calculates his IRR by 1 month increments. Mine might be more accurate than Ryan's, but Ryan's jumped up a point or two. So you might be like, well, Ryan's is better. In the end, you're going to get the same cash in your bank account. So he says, be careful on just using just the numbers, because it's like sometimes legitimately they can be calculated differently. Other times it can be an accident. So don't, he's like, that's okay. But even if those are not the top priority, it's the team and the business plan that they plan on doing. And for you and I, Ryan, I've always said, come meet us. And that's why Ryan's been to many of our Learn and Grow events, which are, you can actually get to know the team. And do that for any group you're looking at. That's your home run. That's your number one goal. Number two is to get to know them virtually. Everything about a private deal is private. It's not Wall Street. Wall Street, you just read the news and take a guess, because that doesn't tell you pro or con. Private.
And
Get
to
to know the
add to
people.
that, Josh, like you're saying with the accredited, I was going to say, there's plenty of deals and people to find, especially like you're saying with the fund and flip. I mean, I do that personally myself, and anybody can kind of do that, and there's people all over the
Exactly.
country doing it. So it's not specific to, just one spot. I mean, usually people that are doing it have kind of a bit of a territory that they know and understand, and that's why it works. But they can find that. But I don't know if you saw the other question that came through, not in the chat, in the Q&A, which is a pretty good question there.
It's a great question. Does depreciation apply the same way for syndication as for residential rental properties? It does. And that goes back to the picture of my father-in-law leaning up against the jet. He could have bought a rental house and had all the depreciation, all the income, and all the work, or he could have spent the same money and bought into our deal before he passed away, and he would have gotten the same tax benefits. Because a syndication, what you're doing is you're funding an LLC that the LLC then owns the real estate. So you're becoming an owner when you invest in a syndication. Maybe that doesn't get said enough. You're not just like a shareholder. You're listed as one of the owners at your percentage ownership of the entire business that owns the real estate. Now it's an LLC, usually with the real estate. Therefore, you get what is called pass-through treatment. So long story short, almost every syndication you would find, it would be a LLC with pass-through tax treatment, which means you get the benefit of being the owner of the building. It's as if you bought the building for the $50,000 you invested. So you'll get your $50,000 equivalent of the depreciation. Now, we're on Camaplan's webinar. So Camaplan, of course, there's different nature there, right? You're putting money into an IRA, and then the IRA is investing. So the IRA will also get that K1, which we're going to show you in a minute. You're asking great questions. You may not be able to materially benefit from the depreciation in your IRA. Did I answer that okay?
Yeah, and I'll just mention it for people. We won't get into it today, but we have other webinars if they want to look that up. UBIT and
Yep.
UDFI. UBIT's unrelated business income tax, and UDFI is unrelated debt financing income. So again, it comes down to the structure of the deal and how that's structured. But like you said, you're not going to get a benefit with the IRA.
So now let's just talk about the next thing that should be crossing your mind, and that is Rabbi. Thank you. Thank you very much for asking questions. Everybody, keep asking questions. It's your seminar. We're only here to be of service to you. The underwriting is the next step, and this is maybe a hurdle for some people. You're like, okay, so now I know the sponsor. I like them. I understand the type of real estate, and all I need to understand is how the business plan works. Do I believe it or not? It's always your choice. And now you say, well, but I'd like to see how the numbers work. And that's, often called underwriting. Now, of course, we've all been through underwriting when we got a house loan. And this is just a definition about a house lender lending you verify your income, your assets, your debt, and in order to find final approval for your house loan, right? So it's it's very similar to you. You're now the bank investing, okay? And so what you'll end up getting are things like this. You'll get spreadsheets, okay? And you'll be like, well, I don't know how to read a fancy spreadsheet. We actually usually try to keep them simple, but for the sake of it being an exercise, take a look at the bottom line. Sometimes that NOI should have been written out because we're not trying to make it overly complicated. We want everybody that looks at things to understand things. Typically, I look down there, right? I look for the fees that are being charged to consider them fair, or do I not consider them fair? Cheap fees by the company, I mean. Then I look at the profit. And, of course, you can look at everything in between. But the profit or the NOI is the key because in commercial real estate, so mobile home parks, multifamily, hospitality, any kind of mixed use building or flex space building, all of it, no matter how pretty the buildings are, tends to be evaluated by the appraiser using the NOI line. So lots of conversations you and I can have about that. If you take the profit and you typically take that profit, let's do this together. And let's take that 3 million, 3,021 or 28, that would be 3 million. And just for sake of keeping it simple, just do 3 million, divide it by the capitalization rate. In this case, let's make it a 7. So relatively conservative. And you're going to get you're going to take 3 million. .07 equals a $42 million valuation. So all things being equal, the appraiser is going to come up with one of their line items and say, based on industry standards in the market, 7% capitalization rate, the NOI divided by the capitalization rate is their what's called income-based approach to value. You're going to hear that all the time. You're going to say, what's the cap rate? Feel free to ask us more questions on this, but otherwise I'm going to move on because it gets a little complicated, but you're going to want to understand that topic, the words capitalization rate. A couple weird things about capitalization rate. The higher the number, the cheaper the building. Crazy. So for example, in multifamily, it's like 4% nowadays. You're like, well, that's not sounding very good. But that means if they make $1 million, it's worth 40 million bucks. So it's like the lower the percentage, the higher the value. So we can get, there's no other Q&A. Let's go on because I don't want to bore you on that. But, again, this is an exercise in what is available to people like you. This is hospitality investment process. The investment process for all practical purposes. I think I've watched so many webinars of people like me, and the process seems to be consistent. They'll usually send out an investment prospectus, like a 1-page or a very simple email. If you're on one of their emails, it'll either it'll make sense and be attractive to you, or it won't. If it's attractive to you, you'll want to go to their webinar or their due diligence presentation. And on that, they're typically going to go through the underwriting. Okay. And they're going to show you, how they believe they're going to make money. Okay. And, we have too much detail here for this presentation. We already talked about value add versus stabilize. That is actually going to be the two choices of a business plan. All right. And this is me just kind of sharing with you until I get more questions. I have one question. What is the typical exit strategy, Rabi? For us, it is a buy and hold with refinance to recapitalize. That's actually a great question. And maybe I can define what I just said. Either you're buying things to hold for 4 years and sell, or 5 years. That's called a value add. See that? A value add play means you're buying something cheaper because it's like a fix and flip. It could be a big commercial building. It could be anything. It could be a warehouse building. It could be apartment buildings. Your goal is to change the value. And that usually means some construction, and it always means some better business operations, meaning charge more, cost less expense. When you do that, you change the value, create wealth. That's wonderful. It means you usually don't have as much cash flow in the first few years. And then all of a sudden you get a big sale and you big cash flow. So that's a wonderful strategy. 9 out of 10 multifamily deals you see today are value add, maybe 9.5. There's very few that are encouraging you and I to buy multifamilies that are perfect. And you know this because you've seen other presentations. Everybody's like, well, the place is run poorly and they need to charge $150 more a room. That's called a value add strategy. Now, the world of stabilized asset investing is less volatile, meaning you should be able to invest in something with a very clear path, but you're really only going to get the returns they promise. There's probably no other upside. And that's where something is fully rented out, fully maximized its benefit. It's running really well, and one entity is buying it from another entity at full price. This might be like a turnkey rental concept. It can be great because at least you own an asset that is going up inflation, but it's not meant to be like mega wealth building. It's more like wealth protection. Okay, so that's the two basic strategies of business plans. And what is the typical exit strategy? I just answered, and that is, so in a value add, it's almost always flip it, fix it, spend 3 years getting the money right, spend 1 year under construction, maybe two, then get the money coming in at the consistent rate at a higher rate. That'll change the value to the valuation company, and then sell it. Or stabilize is typically a long-term hold. So we move from value add when we buy things, and then we move them into a stabilized long-term hold, and we use debt to pay back our investors. Let's go to the next slide. Just interesting stuff here. Why don't we do this? I mean, I think just a tidbit here, if you're investing multiple ways, some people invest out of their IRA, and usually you want to do things that have like debt. Debt is killer in an IRA. If I had most of my resources in an IRA, what I would be doing is lending, because you can get the collateralization on the project or the property or the equity of the owner, and get a check every month at a really high rate if it's a private deal, anywhere from 7 to 12, maybe even more, depending on how risky it is. But it has this collateralization. So at our company, we recognize that IRA people like myself would love collateralized debt. So we're in the final stages of launching something like that. We don't have it right now, but I know you guys all have other ways you can loan people money, direct deals, like Ryan just said. You could help a house flipper and loan them money. For us, we take care of people on the full life cycle. We call it the carousel. You got to go around this circle every year, get rid of your taxation problem. So we designed, equity. You want to buy the horse and let it grow forever. That's buying a building. Debt is putting debt on the building and getting your money back at a high yield, but you have safety the whole time, and then you're done. And then EIF means for people that use after-tax dollars to help them get rid of their taxation problems. They invest in high cash flowing leases. So cool stuff. We've kind of designed our strategy to fit what I do. Okay. Basically, we looked around at all the best family office strategies, all the best wealthy people. I grew up very poor, so I had to learn from other people, of course. And they just make sure they buy this is from Rich Dad, Poor Dad. I wish I had my book in his hand. He says the rich buy assets that throw off cash, right? So if you want to do that strategy of buying assets that throw off cash forever, you usually want to think about things that are going to charge more in money later, meaning they charge $100 for something this year, but the inflation, they're going to be able to charge 110 next year. So you want things that have cash flow that can go up with inflation so that you get paid even when the inflation happens. And you want to have different assets that take care of your tax situation. So we at Accountable Equity coined the phrase of the golden carousel. Now, when you become a private investor and you jump into syndication, even if it's just for part of your portfolio, the rest you might keep in Wall Street or whatever you might do, you're going to start receiving these K1s. Now, the K1 document is your IRS document you get at the end of the year when you're in private deals. And I'm not a tax expert, but we're just pointing out some interesting things that happen when you use after-tax dollars. It also happens with your IRA, but as Ryan and I mentioned, you may not be able to benefit from this as much in the IRA. You won't be able to benefit from the passive losses. But wow, these are really cool things that happen. We went and built a solar program for our green energy, and we used this mechanism we created with our lawyers called an efficient income fund, where we let the investors own all the equipment. The operating company pays them monthly a lease because the operating company wants to keep their lease cost as low. These guys just want massive depreciation going up into the ether so that IRS bills are lower, right? So someone put in 100,000, they got $88,000 of bonus depreciation, which means it's as if the IRS said they lost 88 grand. So they wrote a check for 100, but then the IRS let them say they lost 88 grand through depreciation. And then because it was solar, we got this crazy bonus where they gave us $28,000 each in credit toward regular taxes. So really crazy good stuff, right? But all in, look what happened. A person wrote a check in 4 months, right in November. So they ended the year 2020. Their tax savings equivalent was $61,000 that year. Okay. Crazy off of 100 grand. So that's very high use of the IRS code. All right. I'm going to have to go on all this. I'm going to just break out of the presentation and just take the last few questions and see how I can be of service. Is there anything else you guys would like to cover? I will be here until Ryan kicks me off. Ryan,
I was looking there to see, I thought one, but I think it was something that was already answered.
You know what? There's this too, Ryan, though. I did want to say to your guests who are ever here, most of us are in driving distance. And you probably know our good friend, MC Laubscher, the Cash Flow Ninja. He is speaking. You know, we keep the cost for this minimal, so don't worry. This isn't a sales pitch or anything. But you can actually come to one of those mingling events with food and education and a keynote right around the corner here. It's at the Renault property. There's the QR code if you'd like to register. He's speaking. All kinds of great things there. So this is really the nuts and bolts of how you do private investing. You meet people.
Absolutely. And I know he's, I don't know if you mentioned that before or not. You also have your podcast, Capital Hacking, and MC has his Cash Flow Ninja. And I think he has two of them for people that don't know him or want to get to know him. He's got a lot of great information.
The pleasure to serve Camaplan, Ryan, and do these webinars. We are here. I mean, Accountable Equity is all about leading with education. So whatever we can do to help, our website usually has, you can directly communicate with me and Amalia. And
you know what, Josh, did you have a slide with your information for people?
You know what? I think this might be the best one. Now, as far as a phone number, you know what? I just don't think I have our phone number but you know what? Let me just point this out, friends and family. That is the URL, Accountable Equity. You can go join us at a Learn and Grow, or you can pull your iPhone out. I don't know if you've seen this before, Ryan, but that QR code works, bro. It literally works right through your computer. I never knew you could do that until recently. Like right there. It just did it. It's the best. I mean,
I know.
Keeps
technology keeps moving forward, right? Maybe one day you and I are to be able to get to space.
Wait a second. That's your family business. Yes, it is. There's another Q&A. Let's see who we have. Ali. Josh is going to be my new mentor. Okay, he just doesn't know it yet. Josh, look out for an email from Ali. Ali, you're on the team, brother. Oh, you're on the team. Definitely join us on the podcast too. That's free and pretty awesome. Click those links too.
Awesome. Well, I appreciate you taking time out of your day. I know you're a busy guy, Josh, and if anybody has any questions, feel free to reach out to Josh or myself. Again, Ryan Fisher, Camaplan. And you can also get all our upcoming events on our website under Cama Academy, upcoming events. Thanks for being with us today, Josh. Really appreciate it.
Thank you. It's always fun.
Yep. Bye-bye.